is brought to trying to you trying to make out and select the best source which you can minimize the cost for a given product. All right. Okay, someone was disturbing. So, anyways, that's actual cost. The managers here would be of the opinion that the value of the firm should increase. They strive always to increase and maximize the value of the firm. Okay, and minimize the cost which is incurred in order to produce a product, good or service. So here there can be, cases where a manager happens to decide upon the, situation comes for a manager to relocate also. Okay. So actual cost is all about the relocation of resources. Okay. All this in short, if you have to tell, to minimize the cost of production, to minimize the cost incurred at various levels, so that the profit maximization of objective of the firm can be attained. Next is business cost, which is also known as accounting cost. This includes various expenses which are incurred to carry out the businesses, such as the cost of depreciation, depreciating the plant and the equipments, machineries, land building, various payments which are on contractual basis, etc. All right. These cost concepts are, for calculating the profits and losses for the firms, which includes income taxes as well. Okay, now on the contrary, what is full cost? Full cost is also known as economic cost, which is including business cost, opportunity cost, and normal profit. Okay, this opportunity cost includes expected earnings from the second best use of the resources. That is the alternative choice that you have from there. It is the best expected, cost which can be incurred onto include it in your list. The market rate, the total money capital. Normal profit is necessary, minimum earnings in addition to the opportunity cost, which a firm either get to remain in its present occupation. So hence here the business is part of full cost. Total cost includes only the business cost, but also opportunity and implicit cost, are balanced so that the business cost is minimized. And all this is meant for all the, attempts which are done are only to ensure that the cost is minimized and the profit maximization is done. All right.
Ma'am, we are unable to hear you.
Ma'am, we are unable to hear you.
Hello? Hello, everyone. Can you hear me?
Yes, ma'am. Now you are audible. Thank you.
Yes, ma'am.
You can hear me? Yeah. There's some there was some internet issue. And yes. Okay. So I think explicit and implicit cost, we were talking about. There, I think audio cut down. Okay, so explicit cost and implicit cost. Explicit cost is a cost which is also referred as business cost. And this involves full, up cost and opportunity cost, which is not accounted in accounting because they are included in implicit cost in accounting. Okay. Just now we've understood, right, that cost like advertising, all these are not included. So explicit costs are those which are actual payment to other parties, like advertising, commission, brokerage, etc. To other parties, when you pay, we call it as explicit cost. And implicit cost includes other than those which are not included in explicit cost, like more often to, the to run a project. For example, a manager who is running a business, okay, forgoes the salary that you are earning. Suppose in a person A, he is an entrepreneur, okay, and for some reasons, when he is foregoing a salary of rupees 1 lakh per month just to run his own business, that becomes an implicit cost. Okay, the investments which are made by a person in the business by withdrawing some other better options or the worst options, that becomes as implicit cost. Okay. Also, it includes certain deposits, interest rates, investments, etc. So, explicit costs are the cost which is given or paid to other parties. Implicit cost is the cost which has been foregone in order to continue doing this business or activity, etc. What do you forego becomes your implicit cost. What is paid to the expertise, external packaging, or say advertising, transportation, etc. becomes your explicit cost. All right. Next we have out-of-pocket cost and book cost. What is out-of-pocket cost? This means that it refers to usually the cash payments which are paid to outside. This basically, differentiates the transferability and variability with output. And not all the, out-of-pocket cost will become variable. For example, salaries which are paid to the staff. Okay. And costs such as depreciation, They do not require current cash payments. So in this concepts, the distinction is quite different because of the traceability and variability. It doesn't happen at present. See, depreciation account is maintained with respect to a particular asset in order to, secure the future with regards to that assets. Future may, if anything goes wrong, wear and tear to the asset happens in its lifetime, then this depreciation account can be used in order to repair or replace the asset. So like that, out-of-pocket cost and book cost, out-of-pocket cost is where is depreciation. It includes depreciation, salaries which are paid to staffs, etc. So all these cost doesn't come under out-of-pocket. Okay, like payment which is made to in the form of salaries to a staff, we said electric power bills, and some in different cases they are to be different. Okay, sometimes these can be directly traceable, sometimes not. So how do we identify them and put up as out of pocket cost are those which are which involve current cash payments, and these are considered while you are accounting as well. So this usually happens when a business goes for expansion, development, and book cost at that time may not be included in the form of assets, but yes, transfer of old equipments to new areas, okay, will be shown in the accounting book, and it is taken into consideration while you are doing accounting. So book costs basically are converted into out of pocket cost by selling the assets, and they have even at times they are brought on hire and lease also. So rent in that case would become the depreciation, and the interest received on those amounts can also be out of pocket cost. Okay. And then we have fixed cost and variable cost. What is fixed cost? Fixed costs are those all those costs which are associated and which exist in the firm in the firm for a given activity which is fixed. Okay. And though the firm or that particular manufacturing unit, suppose if we talk about a unit or a segment in the company, either that is manufacturing or not. Okay, the cost which is put on in order to maintain it, like the assets which are being fixed there, are to be maintained. The labor which is hired are to be paid, the wages, the salaries to be paid to the administrative staff, and kind of electricity, all these becomes imperative, and all this put together will become the fixed cost. So even if your utility is zero, that means usage is zero towards this particular segment or the unit, manufacturing unit, still the company will have to bear the fixed cost expenses. Variable cost are those costs which either increase, fluctuates with the number of units which are manufactured in the firm. Suppose 1,000 units are manufactured, 1,000 into variable cost per unit will be calculated. Unlike fixed cost, it will be fixed. Now, whether you produce 1,000 units or tomorrow your production may come down to 500 units, or it might increase to 2,000 units. The fixed costs remain fixed. Supposing for a given day, fixed cost is 5,000 rupees. So whether you are producing 500 units, 1000 or 2000, your fixed cost remains 5,000 rupees only per day. It won't change. It won't fluctuate. Whereas variable cost will be based on the unit per unit. And this will change as the number of units which are manufactured will be changed. Suppose if 500 units are produced and say variable cost is rupees 5 per unit. So when 500 it is produced, if it is able to manufacture, or in that scenario, variable cost will be 500 into rupees 5 per unit. So 500 units into 5 become 25. Likewise, 1000 units, 5,000. Likewise, 2000 units, 10,000. So 10,000 variable cost. Now you see, it is changing from 2,500 to 5,000 to 10,000. When the number of units are increasing, the variable cost also will increase. And if it is decreasing, the variable cost also will decrease. So fixed cost is something which is fixed. Investments in such as, like in assets, land, building, technology, etc. Variable cost are all those expenditures which associate with the level of output. Okay. Next is total, average, and marginal cost. Now, what is total cost? TC, it is denoted by. AC is abbreviated as average cost. Marginal cost is abbreviated as MC. Now, the relationship between total cost, average cost, and marginal cost, last week class we have learned. Average cost is not an actual cost, but it is obtained by dividing total cost divided by the total quantity which is being produced. Supposing if the total cost is rupees 20,000. Okay, and the quantity produced is 5,000 units. Okay, if you divide this with 5,000, you will get average cost. Okay, so total cost is 20,000 and 5,000 is the quantity Q. 5,000 is the quantity Q. If you divide total cost with the quantity, you will get average cost, right? Is it clear, the relationship of, average cost and total cost? Next is marginal cost. Now, what is marginal cost? It is the addition to the total cost in the scenario when the quantity is being added in the next level. I'll show you that. Last class also we've understood this in the previous sessions. This will be obtained by MC. Here you can see is equals to total cost divided by the quantity. Total cost divided by the quantity. Okay, the change in the total cost is divided by the change in the quantity of production. In the table, if the total cost is, for 5,000 units, it is 10,000. 6,000 units if it is 12,000. This from 10,000 to 12,000 change what is happening to the total cost because of the increase in the quantity. This is in thousand, say. This is in 1,000. Okay, this say TC it is. The change what is happening, sorry, this is 12. 2,000 difference what is happening will become your MC. That is marginal cost. Okay, the change TC divided by Q. That is 12,000 divided by 6,000, which becomes 6,000 units. So that way you try to find out or calculate the marginal cost. Average cost is TC by Q. Marginal cost is the change in TC divided by Q. Then we have incremental cost and sunk cost. What is incremental cost? Incremental costs are basically those additional, cost which are required for acquiring new machinery, for developing a new technology, or for expansion of business, adding up a new segment in the current business. So that way, when you're adding expansion is happening in the firm, that addition becomes your incremental cost. It can be anything in any way, expansion of a segment, or adding up one more asset to the existing unit. Plant and machinery is purchased, a new machinery has been added, or say a new technology is being developed by research and development cell. So that way incremental cost can be identified. Incremental cost are those costs which refers to the total additional cost, okay, for implementing any decision. And those managerial decisions can again be referred to all those decisions which again in turn will result to profit maximization, expansion of business, wealth maximizations, etc. Next, sunk cost. What is sunk cost? These are all the expenditures that have been paid, okay, in the future as a part of contractual agreements. And examples are of the sunk cost are rental payments, long-term lease. It can be land taken on lease, machinery taken on lease. So all these payments which are made in order to ensure the future, these are all future payments which are done, which expenditures which are incurred in order to retain the same consistency in the activity for future, by paying lease amount for a given plant and equipment. Technology is brought in on lease, say a land is occupied on lease, or warehouses, okay. All this, when you are paying, expending anything on such items, we call it to be a sunk cost. Okay, next we have historical cost and a replacement cost. Now, what is historical cost? It is very simple. It is something which refers to actual cost which is incurred in order to acquire the asset at that time of acquisition. Suppose in today, that is 26th of August, when you are trying to buy, when you go to buy a particular asset on this date, okay, whatever is the actual cost which you incur, suppose in the asset cost 1 lakh plus transportation and fixing, installation, all put together another 10,000 addition. So 1 lakh plus 10,000, the actual cost which is incurred to bring in that asset to your manufacturing unit or to your firm will be 1,10,000. That is your historical cost. All right. Okay. Then there are, sometimes the cost which is incurred may fluctuate. Suppose in what you buy today, tomorrow if you go to buy same thing and you estimate that it might cost you same 1,10,000, no, it cannot happen for some given goods and services because of various economic conditions and non-economic conditions also, inflations, etc. The cost may not be same. Okay, in this case, whatever is exceeding, the cost which is exceeding, okay, due to the deflationary situations, that cost is called as a replacement cost. And usually when you see, the replacement cost is always lower than that of the historical cost. Because of deflation, the rate might come down, and so it is referred as replacement cost. So today, if you are buying at 1,10,000, tomorrow when you are valuing it, the value may come down because of, you look at the market value, the value may come down because of the various conditions which are prevailing in the economy. Okay. And these examples for historical cost and replacement cost, like petrol, diesel, onions, tomatoes in the recent, past, or rice, grains, wheat, millets, all these can be taken into and to understand the historical cost and the replacement cost. All right. Next, and the last one what we have here is private cost and social cost. What is private cost? There is something called or referred as a cost benefit analysis for firms. And the cost which is borne by the firm themselves, the cost which is like actual cost which is incurred in order to perform the activity of the business, like production, consumption. But actual costs incurred should include both implicit and explicit. And when you combine these two, it becomes your private cost. It becomes the private cost when you include both implicit and explicit. Implicit refers to all this interest, insurance, depreciations, etc. Whereas explicit cost includes the raw material, wages, rents, etc. All this, when you together, will become the private cost. Social cost, on the contrary, on the other side, is the cost which you spend on the society. Social cost. I think you all must be aware of CSR, corporate social responsibilities, those who are working in the companies, etc. We often hear this word CSR by banks, CSR by companies, etc. So the social cost which is put up by the firms in order to protect the society directly and indirectly in big way or the small way, that becomes the social cost. Example, the kind of initiatives that a company takes up in order to ensure that any harmful products which are sold in the market are to be ensured that they know with the complete detail the consumption, the one who is consumer would probably understands the kind of attention will be grabbed, and they should be made aware about the various causes. The kind of examples like smoking, cigarettes, alcohol, these can be taken as an example. Other than this, like traveling insurance, all these also can be considered while you go on trips, etc. So social cost basically had a very, significant, of all the costs, it becomes a significant cost because of the, though it is very significant, but private cost mostly becomes, more, weighted and understood than the social cost, which is being otherwise made mandatory by the governments to include and then show it, efficiently how better they are able to serve. So private cost and social cost, at which the cost, the product is being sold to the society, that is considered as social cost. The risk of, using the product, the risk, sometimes it is calculatable, sometimes may not be. So therefore, the social cost is significant, of course, very important. But as compared to private cost, it becomes, less focused on. But yes, these days, awareness is brought in, and the social cost is also becoming more relevant and significant as well in various forms. Okay. Any doubts until here? All the various cost, opportunity cost, actual business, out of pocket, short run, sunk cost, historical cost, variable, all these concepts are there. In short, okay, next, I think tomorrow's class we can continue with the short-term cost and the long-run cost, etc. Any doubts until here, anyone? Well, if not, then we can stop the class. Yeah. Good to hear, Vishwanath. Then if we'll end up the class session here. See you all tomorrow. Good. Good, Karthik. Okay, all then. See you all tomorrow. Oh, Vishwanath. Vishwanath. Okay, Vishwanath, would you be attending tomorrow's class? I think it's 1:05 already. If it is quick enough, I can finish it off, but otherwise we can immediately start tomorrow's class with your doubts. Okay, Vishwanath. So tomorrow, I think you can be ready with your doubt at 12, I think, yeah, 12 o'clock sharp, we'll start the class. So we'll start your class, the class with your doubts, okay? Right, Vishwanath? See you tomorrow then. Take care, everyone. Bye-bye. See you all tomorrow.
Okay, madam.